Welcome back to Alpha Recap, your end-of-day wrap from StockAlpha.ai. We're closing out the trading day with a quick look at what moved markets and why it mattered. As always, if you have questions, you can reach us at StockAlpha.ai.
Great to be here. Markets closed after a day that was really shaped by small cap volatility and a few corporate updates that investors should note.
Oh my gosh, small caps stole the show. So, what really stands out here is that one name, a tiny company that plunged and traded like it was a headline stock.
You're talking about the stock that fell about 4.7% to $2.03. And it did that on unusually heavy turnover.
Yes, and the volume was huge for that name. It traded roughly 142 million shares, which is a classic liquidity-driven move that can exaggerate price swings.
Right. When thinly traded names see both a sharp price drop and very high volume, that's a volatility signal. Short-term traders felt it. Long-term holders probably had to reassess position sizing.
Quick reaction. Traders should watch intraday volume and any company-specific news. Long-term, reevaluate until a clear catalyst shows up. Simple, but important.
Exactly. And remember, big percentage moves in small caps can trigger correlated selling across similar risk assets, especially on a risk-off day.
Wow, big move.
Also on the oddball front, an asset manager bought a single share of Texas Pacific Land for $532. One share. That's a signal tracking move more than anything else.
That always makes me chuckle. One share. Attention grabbing, not portfolio changing.
Yeah, that tracks. Investors should only treat single share buys as something to file away for pattern recognition. If it's repeated, then it matters. Let's shift to enterprise tech, where the narrative keeps getting louder around AI and industrial cloud.
Ooh, I love this stuff. Microsoft stepped up as a gold sponsor at the 5th Annual Connected Worker Energy Summit, which is basically them leaning into industrial cloud and frontline worker workflows.
Right. Sponsoring a summit like that isn't just PR. It's about pipeline and upsell opportunities for the cloud business and industry-specific software. Pilots announced at these events can become real revenue later.
So, when you say pilots, you mean real tests with customers that could roll into paid contracts, right?
Exactly. A pilot that proves value at an operator can lead to wider Azure adoption or a software-as-a-service rollout across an energy fleet. Those are the things that move enterprise software peers.
And relatedly, Mequilibrium appointed a new CEO to scale their AI workforce intelligence and wellness platform. That's the consumer meets enterprise wellness angle we keep hearing about.
They're pivoting toward a product-first AI analytics stack aimed at large corporations. If they land Global 2000 clients or pilot wins, that validates the commercial path and could pull up comparable wellness and HR tech stocks.
Which is why investors should track partner lists and customer announcements coming out of the summit. Those are potential catalysts that actually mean recurring revenue.
Right. In plain terms, sponsorships and events are where deal flow gets announced. Watch for customer case studies after the event.
Okay, quick reaction. Interesting intersection.
Let's pivot to health and wellness. Another theme that showed up in multiple ways today.
I love this because it spans consumer, corporate, and even biotech. Media Planet launched a nationwide rare diseases campaign in USA Today to raise awareness, which can drum up funding and collaboration.
And separately, a consumer book reframing anxiety as deployable energy was released. Not a financial event, but it signals persistent consumer interest in mental health content and services.
So, what really stands out here is that media attention can translate into dollars eventually, through funding, partnerships, or paying customers for digital therapeutics and wellness platforms.
Right. For investors, the real thing to watch is follow-on activity. Partnerships, licensing deals, or funding that turns awareness into measurable revenue for public companies in that space.
Short reaction. More attention equals more potential demand.
Switching gears to education services, BMO cut its price target on KinderCare, citing enrollment weakness, which highlighted operational risk in childcare businesses.
That was not great. Enrollment-driven models have fixed costs, so when enrollment slips, margins get squeezed fast.
Analyst downgrades like this can increase volatility. Investors should watch company disclosures on enrollment trends, pricing power, and cost containment.
Yeah, that tracks.
Now on to media and alternative finance. A film festival in Shenzhen convened thousands of participants, and an indie producer announced an investment-first financing model for a new project called Shadow Fist.
That is so cool. Independent projects being framed as structured investments could attract new capital. But it also adds complexity around liquidity for investors.
Exactly. For public streaming platforms and distributors, festival pipelines and licensing deals matter. For investors, the financing terms will determine whether these projects are institutional-grade assets.
Short reaction. Creative financing is here to stay.
Finally, industrial services. A company rebranded and joined a national partner network to support industrial refrigeration operators. Rebrands plus network partnerships can signal a commercial rollout.
So, when they rebrand and join a network, it often precedes customer contract announcements, which are the real proof points investors want to see.
Right. Follow-up here is essential. Look for contract announcements, coverage maps, and recurring revenue metrics to validate the strategy.
Okay, let's sum up the patterns we saw today in plain English.
Event-driven positioning was clear. Sponsorships and festivals were used to create deal flow. Wellness narratives showed up across consumer and enterprise. Creative financing models are cropping up in media. And small-cap liquidity events matter.
Big takeaway. Sponsorships and events can be leading indicators of revenue, not just marketing.
For risks and what to watch next. Follow up on the small cap that plunged. Look for filings or company announcements. Watch for partner or pilot announcements from the Energy Summit. Monitor KinderCare enrollment updates and any commercialization wins from Mequilibrium.
And watch festival deal flow and any financing term releases for those indie films. Also keep an eye on any repeat institutional activity for that Texas land name. A single share buy is noise without follow-through.
How should different investors act? Traders should respect short-term volatility and prefer event-driven positions. Growth investors should focus on commercialization signals like enterprise contracts and recurring revenue. Thematic investors should connect the wellness narrative across B2B and B2C channels.
Final quick takeaways. 1. Small cap liquidity can swing fast. Be careful. 2. Events matter. Watch the post-event deal flow. 3. Wellness is converging across sectors. 4. Creative financing in media is a new source of supply and risk.
That's a wrap for today. If you want more detail on any of these stories, we'll be tracking follow-ups and publishing updates.
If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for listening. See you tomorrow after the next close.